You have money in a bank account right now. You think that money is yours. You think the number on your screen is a guarantee. You think that because your deposit is insured, because the government promised, because this is America and not Cyprus, the money you worked for and saved is protected. I need to ask you directly, do you actually understand what a bail-in is? Not what the financial media tells you it is, not the sanitized version that appears in footnotes and regulatory filings that nobody reads. The actual legal mechanism, the one already written into United States law, the one that Dodd-Frank made possible in 2010, the one that Starwood Capital's $22 billion fund just triggered for its own investors this year, the one that 3 major private credit firms are now executing against the people who trusted them with their savings. Because if you do not understand the mechanism, you are going to make the same mistake that Cypriot depositors made in 2013. They woke up one morning and found that their government had legally seized a portion of every bank account in the country overnight. Not illegally, not through fraud, through a law that was already in place, a law that most people did not know existed until the morning it was used against them. I have spent 40 years studying how financial systems protect themselves at the expense of the people who fund them. And what I am watching in May of 2026 is the most complete setup for a bail-in event in American financial history. Write this down, because what I'm about to show you is not a prediction. It is a description of what is already happening. Subscribe now. Before anything else, you need to understand the legal architecture, because until you understand it, nothing else I'm going to tell you will carry the weight it deserves. A bail-in is the opposite of a bailout. In a bailout, which is what happened in 2008, the government uses taxpayer money to rescue a failing financial institution. The bank survives, the depositors are protected, the taxpayer pays. The institution's shareholders and bondholders are often protected too. It is expensive, it is politically unpopular, and it produces the kind of moral hazard that allows the next crisis to be larger than the one before. In 2010, the United States Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. Among its many provisions was a new framework called the Orderly Liquidation Authority. The stated purpose was to end too big to fail, to ensure that when a major financial institution failed, it would not require a taxpayer bailout. It would instead be resolved through an orderly process managed by the Federal Deposit Insurance Corporation. It sounded reasonable. It sounded like accountability. What it actually created was a legal mechanism for a bail-in. And here is the part that most people do not understand until it is too late. In the legal hierarchy of a bank's creditors, depositors are unsecured creditors. Your checking account, your savings account, the money you transferred into your bank because you believed it would be safe there, is legally classified as a loan you made to that institution. You are not a customer whose property is being stored. You are a creditor whose loan can be restructured. Under Section 210 of Dodd-Frank, the FDIC, acting as receiver in a resolution proceeding, can convert unsecured creditor claims into equity, reduce them or eliminate them entirely in order to recapitalize a failing institution. Deposits above the FDIC insurance limit of $250,000 are explicitly exposed, and in a systemic resolution event, even insured deposits can be subject to temporary holds during the resolution process. Not permanently, in theory, but in practice, temporarily is the word that destroyed Cypriot households in 2013, and it is the word that is now written into American law and waiting for the conditions that would activate it. Those conditions are arriving simultaneously right now. Let me walk you through each of them. The first condition is what the Federal Reserve has quietly done to its own balance sheet. You need to understand this number. The Federal Reserve has purchased approximately $250 billion in Treasury securities this year alone. Its total Treasury holdings now stand at $4.4 trillion. That figure represents 65.9% of the Federal Reserve's total assets, the highest concentration since March 2008. I want you to think about that date for a moment. March 2008, That was the month before Bear Stearns collapsed. That was the month before the Federal Reserve had to engineer an emergency rescue of one of the largest investment banks in American history. The Federal Reserve's balance sheet in March 2008 looked, in terms of its Treasury concentration, almost exactly like it looks right now. The Fed is not buying these treasuries because the economy is strong and the Treasury market is functioning normally. It is buying them because the private market, the institutional investors and foreign sovereign holders who are supposed to absorb American government debt, are not buying enough at the yields the government can afford. When the demand from private buyers is insufficient, yields must rise to attract buyers. Rising yields increase the interest cost on $9.2 trillion in debt that the United States must refinance this fiscal year. The Fed steps in to prevent that yield from rising to the level the market actually requires. It buys the bonds. It creates the money to buy them. And in doing so, it becomes what economists call the buyer of first resort rather than the lender of last resort. When the institution designed to backstop the financial system is itself becoming the primary buyer of the government's debt issuance, the question every depositor should be asking is this: if the backstop is the buyer, what is left behind the backstop? The answer, when you look at the Federal Reserve's own balance sheet, is $245 billion in cumulative losses that the Fed is legally permitted to call a deferred asset rather than insolvency. The backstop has a hole in it. The hole was there before the bail-in risk materialized. The second condition is commercial real estate and what it is doing to the banks that financed it. March delinquencies on commercial real estate loans jumped 41 basis points in a single month, reaching 7.55%. That is not a rounding error. That is a 41 basis point move in 30 days. The trajectory it implies over a full year, if it continues at even half that pace, produces a delinquency rate that exceeds what the commercial real estate system experienced during the 2008 crisis. Starwood Capital's $22 billion real estate fund has triggered redemption gates. Investors who believed their money was accessible, who made decisions about their financial lives based on the assumption that they could withdraw from this fund when they needed to, have been told they cannot have it back. Not because Starwood broke the law, not because anything fraudulent occurred, because the fund's subscription agreement, the document that almost nobody reads in full before they invest, always contained the legal right to suspend withdrawals when the volume of redemption requests exceeded a threshold the fund could meet without distressed asset sales. The legal mechanism worked exactly as written. The investors were surprised because they did not read the mechanism. This is bail-in risk in its most accessible form. The gap between what investors believe about their money and what the legal documents that govern their money actually guarantee. That gap exists in the fund industry. It exists in the private credit market. And under Dodd-Frank's orderly liquidation authority, a legally more complex but structurally analogous version of it exists in the banking system. And the losses in commercial real estate do not stay in real estate. They flow through the lending institutions that finance those properties. They flow to the banks that lent to the real estate funds. They flow to the balance sheets that sit between your deposit and the FDIC's resolution framework. They flow toward your money. The third condition is private credit, and the specific names you should know before this story becomes a headline. Ares Capital, one of the largest private credit managers in the United States, has written 3 large investments down to zero in the past 12 months, not marked down, not impaired, written to zero. Blackstone is publishing internal scorecards to its own investors to defend the quality of its software loan portfolio against scrutiny from investors who are asking questions the promotional materials did not anticipate. Blue Owl Capital is trading like a penny stock despite managing tens of billions of dollars in institutional capital. These are not small, obscure firms. They are the flagship institutions of a private credit market that grew from approximately $1 trillion in 2012 to over $3 trillion today, fueled by a decade of zero interest rates that made every leveraged loan look sustainable and every covenant-light credit structure look prudent. The investors who poured money into private credit funds were told they were accessing institutional quality returns with professional risk management. What they were actually accessing was the same leveraged credit exposure that has produced losses in every credit cycle in history, packaged in a structure where redemption gates, like the one Starwood just activated, are always available to the manager when conditions deteriorate. The 30-year Treasury yield touching 5% has now made the debt service arithmetic on the most aggressively structured private credit loans negative. The loans that were written at 5 times EBITDA when borrowing cost 2% are now servicing that debt at rates that the underlying business cash flow cannot cover. Those losses will surface, they always do. And when they surface, they will not stay in the private credit funds. They will travel through the banking system that provided leverage to those funds. They will arrive at the balance sheets of the institutions that sit between your deposit and the legal mechanism that Dodd-Frank created to resolve them. Now, I want to address the question I hear most often when I explain this framework to investors who are encountering it for the first time. Is this not what FDIC insurance is for? Yes and no. FDIC insurance covers deposits up to $250,000 per depositor, per institution, per account category. For the majority of individual depositors, that coverage is real and it is meaningful. If your bank fails and your total deposits are below that threshold, the FDIC will make you whole. That is the promise, and it has been kept. But here is what FDIC insurance does not address. It does not address the temporary hold that the FDIC can impose on even insured deposits during a resolution proceeding while it processes claims, values assets, and determines the structure of the resolution. It does not address depositors above the $250,000 threshold whose excess balances are exposed as unsecured creditors. It does not address the systemic scenario where multiple large institutions are in resolution simultaneously, and the FDIC's own resources, currently holding a reserve ratio that has been declining, are insufficient to make all depositors whole without drawing on its own credit line with the Treasury or triggering a broader resolution mechanism. And critically, it does not address the behavioral crisis that occurs when depositors in non-failing institutions, seeing a bail-in event at a major American bank, attempt to withdraw their own deposits simultaneously, producing the bank-run dynamic that is the specific scenario the entire resolution framework was designed to prevent, but has never been tested at the scale that a systemic event would produce. Cyprus was a small economy. A bail-in event at a major American financial institution would not be Cyprus. It would be something the financial system has not experienced and the FDIC framework has not been tested against. Here is the historical record that I need you to understand before I close, because history is the only honest guide to what happens when these conditions converge. In September 2008, the United States experienced what happened when a major financial institution, Lehman Brothers, was allowed to fail without a coordinated resolution framework. The result was a global financial crisis that required $700 billion in TARP funds, trillions in Federal Reserve emergency lending, and years of economic damage that fell disproportionately on the households who had nothing to do with the decisions that created the crisis. In March 2013, Cyprus imposed a bail-in levy on all bank deposits above 100,000 euros. Deposits below that threshold were also temporarily frozen during the process. The economy contracted sharply. Small businesses that needed access to their operating accounts found them frozen. Citizens who had saved their entire lives found a portion of those savings legally converted into equity of banks they had no desire to own. The government had acted within its legal framework. The legal framework had failed the people the legal framework was supposed to protect. In 2023, Silicon Valley Bank failed in 48 hours after a social media accelerated bank run. The FDIC intervened. All depositors were made whole, including those above the insurance threshold, through a systemic risk exception. That exception required a specific determination that not protecting uninsured depositors would create systemic risk. It also required Treasury approval. It is not automatic. It is not guaranteed. It is a discretionary decision made by officials operating under time pressure in a crisis. Every one of those historical events produced the same lesson. The depositors who understood the mechanism before it was activated had already positioned themselves. The depositors who learned about it from the news after it was activated were left managing the consequences. There are two types of investors watching these conditions converge right now. The first type sees the FDIC insurance sticker on their bank's website and concludes their money is protected. They have not read Section 210 of Dodd-Frank. They do not know that Starwood Capital has gated $22 billion in redemptions. They do not know that the Fed's Treasury concentration is at its highest since the month Bear Stearns collapsed. They do not know that Ares has written 3 investments to 0, or that Blue Owl is trading like a penny stock. They will learn about these things the same way Cypriot depositors learned about their bail-in law, from a news headline on a morning when it is too late to act on the information. The second type of investor understands the gap between what the system promises and what the legal documents actually guarantee. They have read the mechanism. They understand that the same principle that allowed Starwood to gate $22 billion in redemptions, the gap between what investors believed about their money and what the legal fine print actually said, exists in a legally more complex but structurally analogous form in the banking system itself under Dodd-Frank. And they have positioned a portion of their wealth in a form that the bail-in mechanism, the FDIC resolution framework, the temporary deposit hold provision, and the unsecured creditor conversion cannot reach. Physical gold held in their own custody outside the banking system, not in an ETF, not in a bank vault, a bank. Not in a paper claim on metal they have never seen and cannot access during a resolution proceeding. In the physical metal itself, the only asset that has survived every financial crisis, every bank failure, every currency debasement, and every legal restructuring in 3,000 years of monetary history precisely because it is not a promise. It is not a claim. It is not a number on a screen. It simply exists. And what simply exists cannot be bailed in. The legal architecture for a bail-in event in the United States is fully in place. The financial conditions that make its activation more probable than at any point since Dodd-Frank was signed are converging right now. Most investors have never heard of Section 210. Most investors believe their deposits are safe in the way that Cypriot depositors believed their deposits were safe on the morning of March 15th, 2013. The difference between those investors and you right now is that you have just been told what the mechanism is, what the conditions are, and what the historical record says about the investors who understood it before the morning it was used. The only question left is what you do with that information